Hey everyone, this is Kirk here again, and welcome back to Option Alpha and the video recap that we do each and every night here at OptionAlpha.com for all of our members. And finally, after 72 different attempts to log into the Thinkorswim platform, I'm finally in. So I'm sorry for some of you. This video tonight's a little bit later than I wanted, but I'm continuing to have issues with the Thinkorswim platform. I'd be curious if anybody else is having issues as well. Just add your comments below. I've definitely been having a ton of issues since probably about the last week of January, and it's just been causing a nightmare. So needless to say, we're back in here, and thankfully we've only got a couple trades to go over tonight, so hopefully I'll keep this short and sweet. I do want to save CMG, which is Chipotle, for the last one that we're going to talk about here tonight. But let's go over real quick AXP and then Tesla, two good credit spreads that we put on here today. So the first one that we want to talk about is AXP. So we sold 4 of the AXP, which is American Express, 92.5 call side of the market credit spread. We sold each of those for a 77 cent credit, so we took in $77 of premium per spread that we sold. Again, that's per spread. We took in 4 spreads, so you can do the math in your head or on a calculator and figure out actually how much we took in premium. But again, why did we make this trade? So what was the logic behind it? Well, 2 things really. And if we go over our strategy guide that we continue to talk about here on the blog and also on the new membership side of OptionAlpha.com, the first thing that we want to look at is what direction we're going at. So what's our directional assumption? Well, right now AXP has continued to trade higher, and it's considered really to pop since after the last couple of days. So right now our directional assumption is that, yeah, of course, at some point we're going to see a downward move in AXP. And that's just natural, right? We want to have this kind of market cyclicality feature that's working towards our advantage. So we also have a portfolio that's a little bit more tilted bullish, which has been really helpful lately. So we want to start adding some of these call side trades, and this gives us a really good opportunity to do that. Now, in addition to being just bearish on AXP short term, we also notice that implied volatility up in the top left-hand corner, and hopefully you can barely see it here, but it's at the 53rd percentile. So it's above that magic 50th percentile that we talk about. Now, this isn't that AXP has implied volatility of 53%. What it's saying is that in AXP and its historical range of volatility is above the 50th percentile, meaning that 50% of the time implied volatility is actually less than where it is right now. So that what that means is that we can take on strategies that take advantage of option selling and premium selling. Those would be credit spreads, iron condors, strangle straddles, etc. So that's why we went after the AXP short call spread. Moving on, we also put on a put side trade in Tesla. So on Tesla, we traded the March 170, 165 put spread, and we sold each of those, 3 of them that we sold all together, for a $1.40 credit. So same thing as AXP, we'll go to the chart. What you guys will notice here with Tesla is that we do have earnings coming up at the end of this month. So we did actually trade these out to March, giving ourselves plenty of time. Now we do have earnings coming up, and that's okay. But you'll also notice that implied volatility is up at the 70th percentile today. So again, we can take advantage of this by selling some of those option spread strategies that take advantage of premium decay and volatility decay. Now, of course, we're going to have a volatility crunch after earnings, but really the big underlying assumption here is where is Tesla going to go at earnings? Now, generally, Tesla usually has good earnings, and judging by just the overall trend of the market, I don't want to step in front of this stock right now, so I'm not going to sell a call spread against it. I'm going to sell a put spread against it and assume that we continue to go higher as we near earnings. Now, as soon as we near earnings and volatility crushes, then at that point we might consider getting out of this trade just on the volatility crush alone, which should lead us a nice yield in profit. And we've done that historically before many, many times. But right now, I would generally try to get in front of this thing and try to sell a call spread against it, looking for some market cyclicality. But Tesla's been a really hot stock, and sometimes you just have to know when to not get in front of a stock that continues to rally. All right, so the last trade that we had here tonight was really a combo trade. We had a closing alert on CMG, and this was the 515, 510 put spread. Now, if you remember back a couple videos, and you can always go back and look at the archive videos on our website for members, but if you remember back a couple videos, we had rolled up the put side trade of the market in CMG as Chipotle continued higher into earnings. Now, that put spread that we had originally entered for $1.50 is now down to 25 cents. So what we did here today in combination with this opening hedge that we have up here is we actually rolled up our position from the 515 put spread to the 530 put spread. Now we took a debit on this one and made a nice little profit on our initial roll that we had up to the 510. So again, locking in profits along the way and adding to our overall credit is reducing our risk. Notice that we kept the number of contracts that we were rolling exactly the same, so just one total spread, and the width of the strikes was also the same, so a $5 wide strike to a $5 wide strike. This overall continues to help reduce our risk exposure, not adding to our risk exposure, but also adding credit. Now, when we did the roll, we also went inverted on this trade. So this is one of the first times that we've actually gone inverted, and I want to go over that in detail in the profit and loss diagram of what this trade looks like now. But we went inverted on this trade, so what that means is that we actually have a call spread that's lower than our put spread. And that's okay because the call spread's so far deep in the money, we're just going to continue to adjust this put spread as Chipotle continues to rally. Now today we added the 530 put spread and took in a credit of 95 cents on that as well. So locking in profits below and continuing to add to our premium. Now if we actually go to the profit and loss diagram here of Chipotle, and this is what it looks like before we added that position. So you'll notice down here below that we have all of our positions, but you see on the Thinkorswim platform, I've untagged the short 530 put spread that we had, just so you guys can see exactly what the position looked like before. Now Chipotle is trading right about here at 545. So today it was trading up here. We had originally, after we closed out of that shorter put spread way down below the market at 515, we have a profit loss diagram that looks something like this. So you'll notice that we're really deep in the money, right? So there's really nothing we can do. And the difference between where Chipotle is now and where it'll be at expiration as far as profit loss is very minimal. So the curve is starting to more flatten out and starting to get a little bit closer to the actual profit loss diagram. That usually happens as we get closer to expiration. So what we did is we said, hey, you know what? We're going to continue to ride this thing all the way up and take in premium. So we added the put spread below the market, and now that makes us inverted. And basically what we have here is kind of this funky looking butterfly or inverted iron condor, whatever you want to call it. But we're inverted here, meaning that we actually lose money between 520 and basically 535. So we have a little bit of playing room between us and the market, and at this point we don't want Chipotle to come down too far in the next 11 days as we head towards February expiration. But what you'll notice here is that we've now reduced our overall loss on this position to just under $300 as it stands right now. So if Chipotle were to expire here exactly where it is or anywhere higher, then we actually have a total loss with the current positions, not including any of the rolls that we've done in the past, of just under $300. Now we've rolled this thing a couple times and we've taken in some profit on each of those rolls. So overall, we're actually looking at a position that originally was going to be a max loss that we've now whittled down to a very small loss and possibly even a profit if we play our cards right. So again, I just wanted to go over how that works out. Don't be afraid sometimes to invert your positions as you get close to expiration. If you can continue to roll these positions up or down, whatever the case is, and add more credit and reduce your overall loss and risk, then that's actually a good thing. So a lot of people get scared about rolling things and inverting their call spread and iron condor positions, but it's actually not a bad thing if you can continue to manage your risk, take in credit, and take off profit on the roll. So hopefully that's been really helpful for you guys. I know I would have probably had a million questions about this had I not covered it, but that's why we have such a great system here at OptionAlpha.com, such a great value for you guys who are members. So if you guys have any other comments or questions about this, as always, please add them to the comment section right here below the video. I'll get back to everyone tonight and tomorrow, and happy trading.